An early look at what we can expect from the local market with Stan Shamu over at IG in Melbourne. Stan, good morning to you. Let's start with what we're expecting from equities today because SPIs are looking pretty healthy. Is this all about perhaps some investors getting in after that 1.5% dip yesterday?
Yeah, absolutely. Yesterday's move was it's starting to look like a massive overreaction to a market which probably had been a bit overcooked over the past few weeks, and as a result, those sort of fickle investors out there will be taking any opportunity to get out and lock in some gains. At the same time, I mean, there is an increase of risk around the world at the moment. We've got sequester that kicked in on Friday. That's definitely one of the main reasons that's warranting a bit of caution for investors. If you look at the actual numbers, I mean, $85 billion is what is set to come out of the US market this year. That's from a spending cut perspective, and about 1.2 trillion over the next 9 years. So this definitely does warrant some caution for a lot of investors out there. We also have China joining this wall of worry. We've got that housing issue that's going on at the moment with those reforms to the property market rattling some investors in Chinese equities there. We also have their recent recovery looking like it's moderated a little bit. So that definitely did see investors get out of a lot of equities yesterday, and it wasn't helped by the fact that a pretty big dividend was coming out of the market yesterday as well. But just looking ahead today, we're actually calling the Aussie market up 0.8%, so that's quite a hefty rise to about 50-50. So that should be quite a good improvement on what we saw yesterday. Just looking at stocks like BHP, which was trading ex-div yesterday, we're calling it up about 1.5%, back above $36 at about 36.09. So that should be quite good for the resource sector. Of course, we'll continue to see commodities struggle with markets relatively risk-off, mainly through the European session yesterday. This might weigh on some of these resource names today, but at the moment it certainly seems like investors will be happy to buy some of those dips. We've got the likes of Sandfire, which reported yesterday. It got upgrades this morning from JP Morgan, Deutsche Bank, and this should support it heading into today's session and might give its shares a bit of a kicker there. At the same time, we've got 19% of companies forecast to increase their dividend yield this year, as opposed to 14% at the beginning of last year. Now, this is mainly on the back of cost-cutting measures by companies, and this has prompted a lot of analysts to feel some of this money they're saving from that perspective will be returned to shareholders. So this should particularly support some of the financials, because they're actually the main culprits or the main drivers of this statistic at the moment. So yes, we should probably see the market well supported at the open. See a little bit of caution, of course, with quite a lot of data on the cards. At 11:30, we've got that retail sales reading, which is expected to show a 0.4% rise. And we also have the current account numbers, which is expected to show a deficit of about $15.4 billion. This will be ahead of the RBA at 2:30. Of course, we've got the cash rate expected to remain on hold at 3%, possibly with a statement just reinforcing the RBA's sort of easing cycle at the moment. But I think we've got 27 out of 29 economists saying they expect the RBA to remain on hold at the moment.
Yeah, we've got a similar, I guess, majority in our poll as well, Stan. I wanted to ask you about the Australian dollar's likely reaction. I guess we're watching for the fine print in the statement to see if there's anything a little unexpected that could move the currency.
Yeah, no, absolutely. It's definitely the currency to watch today. Yesterday, of course, we saw it trade at an 8-month low down to around that 10118 level. And of course, with such risk, I suppose, volatility at the moment, with investors just not knowing exactly what's going on, the Aussie dollar is one of the biggest culprits, being a big commodity currency as well. And with China shares getting a bit of a beating, it was always inevitable that the Aussie dollar was going to be one of the biggest reactors to what we've been seeing. Now, this massive move lower in the Aussie dollar was partly due to some poor economic data locally yesterday. I think we had building approvals missing expectations, as well as company profits. And we've got this China issue with the property changes. That definitely will be one of the key issues going ahead for the Aussie dollar. But for today, I mean, we saw a nice support from that 8-month low. It's been bought up quite significantly on the back of Janet Yellen's comments on just that quantitative easing program. Of course, she's echoed similar sentiment to what we've heard from Ben Bernanke. She's come out and said, you know, they should push ahead with the bond buying program and just keep in mind the risks and the costs. But they're more than happy, it seems, to maintain the current rate of bond buying or bond purchases. So this really did support most of the risk space, especially the Aussie dollar, rallied all the way back to 102. Of course, it's pulled back a little bit to that 1018 level at the moment, but it certainly seems like it's quite steady at the moment. The best way to probably play it will still be to try and sell into strength. So even if we do get data that meets consensus or comes in slightly ahead of consensus, I think going ahead, just the amount of risk that's coming in on markets at the moment from the US, from China, from Europe as well, will probably be enough to warrant a bit of profit taking on the Aussie dollar into strength. So probably that level in that range between 1024 and 1026 will probably be where the sellers will kick in. We saw a bit of resistance there over the last few weeks, so that probably will be the level to watch for the Aussie dollar.
Okay, Stan Shamu, thank you so much for that wrap. Appreciate it.
Cheers, Kate.
Well, all eyes will be on the Reserve Bank today, with the majority of economists